We were discussing the very important first principles as far as corporate finance is concerned. Last time, we said that there are three basic principles that corporate finance follows. Number one is the investment principle, financing principle, and dividend principle. We discussed this all in detail last time. Okay, for investment principle, the question is, where should the company invest in? If it's the mother company that asks this question, it seeks to answer in what industries are we going to invest in. If it was the SBU or the strategic business unit trying to answer this question, it seeks to answer the question, what investments are we going to pursue? Or for example, are we going to pursue this technology, or are we going to invest in this particular prospect? Okay, so that's the question that the SBU seeks to address. On the other hand, a mother company seeks to answer a different type of question. And of course, the objective is to earn the highest possible risk-adjusted return. When we say risk-adjusted return, we say that we benchmark it against the weighted average cost of capital. And the return gained from the investment from the project as measured by either IRR or NPV, okay? Internal rate of return has to be greater than the weighted average cost of capital. How about the NPV class? What's the decision rule? When will a project be acceptable? If the NPV is, the net present value is, anyone? Do you recall? What should be the decision rule as far as investments is concerned? The net present value should be, okay. Yes, thank you, Tricia, you're correct. The net present value should be greater than zero. Okay, the net present value should be greater than zero. Those are the things that guide corporate finance, as far as investment is concerned. How about in terms of capital financing? We say that it's very important for the company to acquire funding for its short-term and long-term projects. Okay, without funding, okay, a company will not be able to survive. Without liquidity, for example, as far as operations is concerned, a firm would need its raw materials in order to produce its finished goods. If it does not have liquidity, if it's not able to purchase the raw materials, then how can it survive? How can it continue its operations without the raw materials? Or how can a company continue to be competitive in the market if it's not able to invest in new technologies? Or let's say their direct competitors are having their presence felt in different branches, in different locations. And if the company is not able to compete in these areas, then it will definitely lose out in the market. So it's important to be able to acquire funding. And on another level, it's also important to maintain a capital structure that maximizes shareholder value. Although theoretically it's good to use other people's money, let's say 90% debt and 10% equity, but that does not necessarily mean that that's the best capital structure for the firm. Guys, a minute. Okay, sorry about that. So financing, guys, it's important for the firm to be able to acquire funds. Okay, that's a no-brainer. Without the funds, guys, the company will not be able to survive. But it's not enough to acquire funds. It's also important to have this mix, this capital structure that maximizes shareholder wealth. And lastly, dividends and return of capital. This is a very important decision making for the firm because they have to decide whether it's good to retain the funds or to give them back to the shareholders. Okay, that's a very important decision that a firm has to make. Okay, continuing on, guys. Okay, I think we discussed this last time. Just to have a review, as far as investing activity is concerned, we said that projects can be either be mutually exclusive or independent. If they're mutually exclusive, then the choice of one negates or means that the others will be rejected. And the choice will be based on the highest IRR. However, this IRR should be greater than the hurdle rate or the weighted average cost of capital. If the IRR is less than the WACC, then the project, any project will be rejected. So we also said that we can look at it in terms of not only IRR, internal rate of return, but also NPV, the net present value. The net present value should be greater than 0 in order for it to be acceptable. Okay? Then by way of reminder, guys, the weighted average cost of capital is computed by the summation of your weighted costs of capital. So you have the cost of the debt netted against tax. So which means since the company enjoys tax savings because of the use of debt, then the cost of debt tends to be generally lower. So mas mura, guys, it's cheaper to borrow funds. The cost of debt is lower compared to the cost of common stock and the cost of this should be, sorry, WP times K sub P. I'm sorry, this is wrong. This should be K sub P, the cost of the preferred stock. Towards the end of the term, guys, we're going to learn how to compute for the weighted average cost of capital. All right. Okay, and then I think this one here we just expounded on the optimal capital structure, the financing. Okay, we said that the optimal capital structure is the one that maximizes shareholder value. Here we showed that the use of debt actually provides the company with, so this is 100 minus 30, 70 times a tax rate of 30%. So the tax is 21. Well, in this case, if there's no debt, the tax is 30. So there's tax savings when we use debt. It leverages actually financial performance. Financial performance because you have lower financing costs in terms of tax. Okay, so the optimal capital structure is the one that maximizes shareholder value. All right. Okay, so just to summarize this, guys, the first principles, the investment principle, we say that it's important to determine where to invest in. And we have the finance dictates that the firm should invest in assets that yield a return greater than the minimum acceptable hurdle rate. So this is your WACC. Okay. Any project that the company invests in should have a return greater than the weighted average cost of capital. And the hurdle rate, okay, we'll explain this in a while, should be higher than the riskier projects, okay, and should reflect the financing mix that's used. That's why we said the WACC is reflective of this formula, right? That's the formula for WACC. And it's a function of the cost of financing. Of course, if the cost of financing is higher, then the WACC will be higher. If the cost of debt, for example, compared to the previous year, the cost of debt was on, let's say, on the average 8%. Now it has increased 10%. Then definitely the WACC should be adjusted as well, because it should reflect the current state of financing as far as the company is concerned. Okay, so we cannot use the cost of debt last year because currently the cost of debt has already increased. Okay, so that's why we're saying that the hurdle rate should be higher for riskier projects and should reflect the current financing mix used. Okay, so also when we talk of the investment principle, it's based on cash flow. Okay, so I'll discuss this in a while. Cash flow and the timing of these cash flows. And then for the financing, as we said, this is again a repeat of what I was saying. Okay, there's the choice of the financing mix should be the one that maximizes the value of the shareholders. And there should not only be the right mix. So what's important is having the right mix. I mean, the balance between debt and equity, and also the right match. There is this matching principle. Okay, this one, match. What do we mean by matching principle? It means that long-term investments or long-term assets should be financed by long-term financing. Okay, long-term assets generally should be financed by long-term financing. So it is actually wrong. Well, it's wrong to, let's say, finance a 100 million project. Okay, 100 million project that will last for 10 years. And then you're going to use the credit card to finance this, which is payable the following month. Okay, who in his proper mind will do that? It's not matched. The long-term asset is not matched with the financing. Okay, so if it's a long-term asset costing 100 million, for example, for 10 years, the life of the project, then the match should be also that the asset should be matched by long-term financing. In the same manner, guys, short-term assets, okay, like borrowing, for example, inventory, which is accounts payable, actually, trade payables. We don't, nobody, of course, will allow us to loan or borrow for inventory for 10 years. Okay, so usually yung mga trade payables natin 3 months, okay, 2 months, 1 month, even 15 days, kasi short term. So for short term assets, okay, short term financing, sometimes medium term financing pwede rin, pero usually pag long term assets, syempre long term financing, short term assets, short term financing. Okay, so that's what we mean by match the financing to the nature of assets being financed. Okay. And then, this is what I was saying a while ago, ensure access to constant inflow of capital. Okay, operations will not continue much longer without the support of additional liquidity. Of course, we know that without the round which is cash, the company will not be able to go around. That's a very basic saying, but it's true. Liquidity is very important. Financing is very important in order to sustain the business, in order to sustain the operations of the firm. Okay, and lastly, guys, this dividend distribution, dividend principle, this is one of the most important financial decisions that a financial manager must make. Okay, the question is, should we return the cash to shareholders or should we reinvest it in the company to improve operations? So that's a very, very ticklish decision that the company makes. Okay. Is it important to return dividends? Yes. Return of dividends or distribution of dividends is very important because it sends a very powerful signal that the company is able to generate enough or excess cash flow. It means a robust, healthy company. Okay. However, if there's the presence of a very good investment and stockholders, I'm sure stockholders would not mind not receiving dividends for a certain period, for as long as they know that their funds, okay, that they invested in are being invested in very good, high return projects. Okay, unless the shareholder, for example, saw a business opportunity where he will earn, let's say, 50%, and the company's estimated return on a particular project is only 30%. Then, of course, in that case, the shareholder, of course, what normally he would do is to pull out his investments in the company and put it there. Any rational investor will do that. Okay, but usually, guys, shareholders might might be busy with other things, so that they might not be able to really find investments like that, unless the investor, the shareholder, spends really his whole time, okay, looking for investments that will provide such kinds of returns. Okay, so dividend distribution. If there are not enough investments that earn the hurdle rate, it's best to return the cash to the owners of the business. Okay, this also will send a strong signal that, as I mentioned a while ago, that the company has excess cash to return to the shareholders. But there should be a caveat to this. There should be a warning to this, because it might also mean that the company is not able to spot or find, or to be creative and be innovative in order to generate more opportunities for the company or more businesses for the company. So the finance department should be very, very careful also with this one, because it can be a two-edged sword. It can send a very strong signal that the company is performing well because it's able to generate excess cash flow, or it can also send a very strong signal that the company lacks creativity, they lack the mental acuity in order to spot more opportunities for the business. Okay, so the company can return the funds in the form of dividends, or the company can also do a buyback. By a buyback, we mean the company will buy back the shares of stock. Now, there are reasons why the company will do a buyback, or what we call treasury shares, which we're going to discuss in the future. Okay. All right. In a nutshell, guys, this is what finance is all about. So finance is all about managing the employment of the funds. When we say employment, okay, when we say employment, the acquisition of the funds, where to get the funds. And number two, the investment per se, the use of the funds. Okay, so this is acquiring funds, okay, and then using it wisely in order to maximize shareholder value. Okay, so this is the both the financing decision and investment decision. And it includes also the decision to reinvest or distribute any subsequent. There should be more cash flow generated. So this is this dividend distribution decision. Okay, let me pause for a while. So far, guys, is it clear? So far, what we have been discussing as far as investment decision making, financing decision making, and dividend distribution making. Guys, kindly chat if it's clear so far. Feedback, please. I would appreciate feedback from 15 of you, guys. Okay, thank you, Angeline. How about the others? Okay, Jaime, thank you. John, Marian, Tricia, Abigail, Julia. Okay, thank you, Jonathan. Okay, salamat guys for the feedback. So far, I hope I'm able to explain the concepts well. Okay, Jingyu, thank you so much. All right, so just to summarize this, guys. Okay, so this is the big picture. Whether it's investment decision or financing decision or dividend decision, it's important that any activity should seek to maximize the value of the business, the shareholder value. Okay, we're not saying that maximize or optimize or satisfying customers is not important, but the main objective should be to maximize shareholder value. Okay, so whether it's investment decision, and we said a while ago that a company should invest in assets that earn a return greater than the acceptable hurdle rate. Okay, so by way of explanation, the WACC or the hurdle rate should reflect the riskiness of the investment. So where is this reflected, guys? The riskiness. The riskiness is reflected in the formula of the WACC itself, okay, which is the summation of WI K sub I. The riskiness is reflected here. The cost of the debt, the cost of common stock, and the cost of preferred stock. So the riskiness is reflected there because the cost of the debt is different from the cost of common stock, is different from the cost of preferred stock. And usually the cost of debt is the cheapest one. Okay, and it's the mere fact that it's netted against tax. Okay, so the component of the debt here becomes weight of debt times the cost of debt times 1 minus tax rate. So we said last time that if the tax rate is 30%, then the net contribution of debt is only 70% of the total cost of debt. Okay, and the most expensive one is the common stock as compared to the preferred stock. Okay, now it's riskier, guys. The shareholders, common shareholders, are the ones that are at most exposed to most risk. Okay, why is that so? In the event of liquidity, in the event of liquidation, not liquidity, in the event of bankruptcy, when the company becomes bankrupt, what happens is that the company will sell off its assets to convert it into cash, and then the creditors are the ones that are paid first, and then the preferred shareholders, and lastly, guys, if there's something left, the common shareholders. Okay, since it's riskier to become a common stockholder, then the return required by common stockholders should be higher than either the debt that the creditors or that of the preferred shareholders. That's why we're saying that it reflects the riskiness of the investment. And the mix, guys, is reflected by the weights. So we're weighing it against whatever the composition of the common stock, the preferred stock, and the debt, okay, is reflected through the weights. So we said as an example, if debt was 10, equity was 50, and let's say, preferred stock, let's make this 20, and let's make this 30. So all in all, this is 100. So the weight of the common stock will be 50%, the weight of the debt will be 20%, and the weight of the preferred stock will be 30%. So that gives us now the W's there. Okay, and that's the mix used to compute for the hurdle rate. Okay, now there's another point here about investment decision. It should reflect the magnitude and the timing of cash flows. Okay, take note, it says here cash flows. It did not say here profit. Now let's have an example. Let's suppose you have a project A, proposed project A. Okay, this project A, and we have this. These are the cash flows. Year 0, year 1, year 2, year 3, year 4. So let's suppose it has a life of 4 years. So at year 0, the initial investment was negative 1,000. So this means cash out. At the end of the first year, the cash inflow is 500. At the end of the second year, it is, let's say, 400. At the end of the third year, it is 300. And then at the end of the fourth year, it is 400. Okay, so take note, guys, these are all cash flows. Okay, when we look at investments, when we determine whether an investment is feasible or not, we look at the cash flows. Okay, now these are the magnitudes of the cash flow. At the onset, we invest 1,000. After 1 year, we get cash flow of 500. On the second year, 400, 300, 400. Okay, my question is, kindly chat please, guys. Should we invest in this project or not? Should the company invest in project A or not? Kindly chat in the chat box if it's yes or a no. Okay, may I have your opinion? May I have your idea about this? What do you think? Okay, may I have 16 answers here? I'm seeing only one. I hope the others will also respond too. I'm excited to hear the responses of the others. Okay, so this is an academic exercise, and we'd like to learn from each other because I want to know what's your idea about this. Why are you suggesting either to invest or not to invest? Okay, I'm waiting for 9 more responses. I hope to get them in the next few seconds, guys. Okay, 8 more. excited to see the response of the other 8 people. Okay, good. 6 more. 5, 4, 3. Okay, 3 more. 2 more. 2 more of our classmates. I'd like to know your response, guys. Let's give our classmates 5 more seconds. It's possible they step out for a while. Okay, so thank you so much for the responses, guys. Let's see. Yes, 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 yes. Okay, most of you answered yes. Okay, thank you so much. All right, so let me just, any one of you would like to volunteer why you're choosing yes? Let's see, any volunteer, guys? Why did you answer yes? Anyone? Okay, let's hear it from Robert. Okay, could you unmute yourself, please? And could you share with us why you answered yes? Why you would recommend the company to go for this investment? Robert? Yes, Robert, please. Hello?
Sir, can
Yes.
you hear me?
Sorry.
Can you hear me, sir?
Yeah, I can hear you, Robert. Yes.
Sir, I chose. Hello, sir, can you hear me po?
Yes, you're loud and clear, Robert.
Okay,
Thank
sir.
you.
Sir, I chose the first one po kasi it has the highest value po compared to the other 3.
Okay. I think there was, I'm sorry, I might have not explained the question very well. This is the whole project, okay? The whole project has a term of 4 years. Okay, so for, this is the whole of this is the cash flow for project A. For time 0, which is now, we need to invest 1,000. 1 year means after 1 year, we get 500 cash flow. On the second year, we get 400. On the third year, we get 300. On the fourth year, which is the end of the project, we get 400. So this is just one project, guys. It's not several projects. Okay, this is project A, and these are the cash flows that come with project A. Okay, sorry, Robert, for maybe not explaining it well, but now do you understand the question?
Yes, sir, understood na.
Sige, thank you. And could you explain why you're saying, is it still a yes for you?
Yes, sir, it's still a yes
Okay.
po.
Okay, why?
Because sir, based on the values per year po.
Cash flow. You can say
Cash flow per
Yes.
year.
Okay.
The rate of return po is consistently high po,
Okay.
ranging from 300 to 500 po.
Okay, thank you. Thank you so much, Robert. That's good.
Thank you,
So,
sir.
okay, salamat ha. Robert was saying that this project seems to be okay because cash inflows range from 300 to 500. Okay, thank you so much, Robert, for your answer to that. Any other additional points, guys? I noticed that all of you answered yes. So who'd like to volunteer and explain, in addition to what Robert said a while ago, why are you saying that you'd like to invest? How about Julia? Julia, may I seek your suggestion, or may I seek you to explain your decision to invest? Julia? Miss De Los Angeles? Would you like to explain the reason why you're answering yes? Okay, perhaps Julia cannot hear me. Anyone, guys? Any volunteer? Would like to hear from you. Why are you suggesting that if you're the CFO, you're suggesting that the firm pushes through with this investment, with this project? Anyone? We need more participation, guys, if possible. Who would like to explain his or her answer? Okay, Jonathan. Mr. Nalmida. Hello, Jonathan. Okay, could you just kindly explain your answers sa chat box, and please direct it to everybody. So while we're waiting for Jonathan to key in his answer, guys, any volunteer, guys? Any volunteer? Jonathan, kindly just chat your answer and direct it to everybody. Okay, I was hoping that this will be a popcorn class, which means everyone would just want to share his or her answer. Okay, Philip, Mr. Enriquez.
Yes, sir.
Yes.
I think since it's already showing a positive cash flow for the next year,
Okay.
that's why I think I would opt to invest in this.
Okay. Thank you, Philip. What do you mean by positive cash flow?
Kasi po is from the start there's already parenthesis, diba? Meaning it's already a cost negative.
Yes, that's the
And-
cash outflow, 1,000.
Yes. Po.
And
By
then?
the next year, you're already making money na.
Okay.
And by the
500.
next 2, 3, 4 years or so on, you're still making money.
Okay. Will you be able to recover the initial investment?
Basing on the 1 to 4 years, yes.
Yes. Why?
The 1 to 4 years already has more than the initial investment.
Okay. How much will you be getting?
Oh,
That's easy addition.
around 600, yes. Sorry, I'm still sleepy.
Sige lang, Philip. So how much is your total cash inflow?
Around 600, sir.
Total cash inflow?
Oh wait, sorry, 1,600.
1,600. And then your initial investment is 1,000. So you get a net of 600.
Yes, sir.
Right? Okay, good. That's a very logical way to put it, because the cash inflows sum up to 1,600. The cash outflow is 1,000. Then it's just very logical for us to say that this investment is okay. All right. Okay. However, guys, thank you so much for your answers. However, it's imperative, guys, that we understand how finance does it. Okay. I think we already mentioned in class. Okay. So si Jonathan pala, thank you, Jonathan. In each year, you gain half of the money invested po, and which shows good start. Okay. Thank you, Jonathan. So pareho din kay sabi ni Jonathan na first year pa lang, you were able to already recover the half of the initial investment. On the second year, you're able to recover 900. And on the third year, you recovered already everything, okay? Because on the third year, the expected cash inflow is 1,200, and that's more than the 1,000. Okay, remember, guys, I mentioned to you 2 measures by which we assess whether a project is feasible or not. Number 1 is IRR, internal rate of return, and number 2 is NPV. In any project, guys, we always make use of this. So in order to answer that question, whether we should invest or not, we ask the question, what is the IRR of this project? Okay, and we compare that with the weighted average cost of capital. If the IRR of this project is greater than the WACC, then this project is okay. Okay. However, guys, we were not given the IRR. We were not given the WACC. But given certain parameters, guys, we will be able to easily compute that using Excel. However, that's for the future. Okay. So since we don't know the IRR and the WACC, okay, we cannot assess it based on the IRR. So that leaves us with the net present value. Okay, now we answered that the total cash inflow is 1,600. Okay, and the total outflow is 1,000. So that gives us a net of 600. Now, question, is this the net present value? Is this the NPV? Okay, the answer is no. That's not the NPV. Okay, and the answer is we cannot assess our project doing this, comparing the total inflow 1,600 to the total outflow 1,000. Why is this so? Why can't we do that, guys? Because of this parameter. The return should reflect the magnitude of the cash flow. So we have the magnitude: outflow 1,000, inflow 500, inflow 400, inflow 300, inflow 400. That takes care of the magnitude. However, okay, this is what we missed out in our analysis: the timing. Okay, now I'd like to ask you one question. If I give you 1 million, when do you want to have the 1 million? Now or after 1 year? Okay, could you kindly chat, guys? Please answer now or after 1 year. Everybody, please, okay, chat. Would you want to have the 1 million now or the 1 million after 1 year? What's your take on that, guys? I'm expecting to see 16 answers, guys. What's your preference? Do you prefer 1 million now or 1 million after 1 year? Okay, John, thank you. After 1 year. Okay, how about the rest, guys? When do you want to have your 1 million? Now or after 1 year? Okay, guys, simple question lang, no? When would you want to have your 1 million? Should you want to have your 1 million now, or should you want to have it after 1 year? Okay, I'm still waiting for the others. Now, Christian, thank you. Abigail now, Shallow now, Trisha, Jonathan, thank you. Okay, how about the others? A few more, guys. As soon as possible, but having it after 1 year is more feasible. Okay. Now, okay, now. Of course, guys, the answer is we would want to have our money now. Okay. If somebody will give us the 1 million, I would say, and give me the option to have it either 1 million or after 1 year. Okay. Okay. Thank you, Abigail, for your answer, thinking about the inflation. Okay. So, ganito yun, ano? Okay. We would want 1 million now compared to 1 million after 1 year. Because regardless of the inflation, if we have 1 million now, you can put it in investment. And then after 1 million, after 1 year, how much will be your money? Okay, it will be more than 1 million as compared to just having 1 million, the 1 million after 1 year. Okay, of course, if you have the 1 million after 1 year, it will be 1 million in 1 year's time. But if you have the money now, you put it in investment, even if the return is very small. Okay, after 1 year, it should not be, it should be greater than 1 million. Okay. Okay, so if you're taking a look, at it from after 1 year, of course, the one with the interest will be greater than the one that's only 1 million. Okay, so we would want our money now. Okay, because money has cost, and we call it the time value of money. Okay, so one peso today, guys, is not equal to 1 peso after 1 year. That's the reality. That's because of the concept of the time value of money. So back to our problem, guys. In this case, it is wrong to add 500 plus 400 plus 300 plus 400. It's wrong to accumulate them and come up with 1,600. Why is that wrong, guys? Because we cannot add cash flows coming from different time frames. So what should we do? We should all peg them to one specific time frame. So what we do is that we convert 500, and there's a formula to do that. How much is 500 now? Okay, so we can convert 500 into its present value. how much is it now? 400 after 2 years, how much is it now? 300 after 3 years, how much is it now? 400 after 4 years, how much is it now? Okay, and there's a formula to do that. Okay, let me show you. The present value is simply equal to the future value, okay, times 1 plus the return raised to the minus t. Okay, that's a very basic formula. So we can compute for the present values of all these cash flows. Now, when we have computed for the present values, that's the only time we can add them. Okay, let's say for purposes of discussion, when we converted all of this to their present values, it turns out to be 1,200. Okay, just for purposes of discussion. If the present values of all of these 4 cash flows is equal to 1,200, then we can now compare it with the 1,000. Okay, we can do that now because all of them belong to the same time frame, the present value. And then if we net this, we have an answer equal to 200, which is what we call your NPV, your net present value. Okay, later on, guys, we'll have a more formal introduction to computing the net present value. So the decision rule is that if the net present value is greater than 0, then we should push through with the project. So as to the question, should we invest in the project? We should first convert all of this into its present values and compute for the net present value. That's the answer to that. Because we have to take into consideration the magnitude and the timing of the cash flows. We cannot add cash flows that belong to different frames. Okay? So pause muna ako. Any questions about this, guys? The magnitude and the timing of the cash flows. Answer please, guys. Paki-chat please kung clear so far. Okay, thank you. Okay, very good. Thank you so much, guys. Okay, but I was really hoping that I would get 16 responses. So far, I've just gotten 8 responses. So yeah, thank you. 9 already. Okay, so I hope, yeah, very good. Really appreciate, guys, your responses. Okay, thank you so much. Thank you so much. Okay, so again, just to summarize, guys, big picture, whatever the investment decision is, it should maximize shareholder value. And that will only happen if we make sure that the internal rate of return is greater than the WACC, or when we compute for the returns, we take into consideration the magnitude and the timing of the cash flows. Okay, and that's where the NPV comes into play. Okay, second concept is the financing decision. Okay, the acquisition of funds for the business. So we have, the company has to find the best mix of debt and best mix of equity. Okay, and what's the optimal mix of debt and equity? It's the one that maximizes the firm value, and also there should be the matching of the assets and the financing. Okay, it's wrong to mismatch it. Short-term assets, then we'll be using long-term financing. Okay, or long-term assets using short-term financing. That's a mismatch, and that will not maximize shareholder value. Okay, this is very important. The right kind of mix and the right kind of matching. Lastly, guys, the dividend decision. If the firm cannot find at the moment investments that earn above the WACC, then it might be best to return the cash first to shareholders, either in the form of dividends or buyback. Okay, the question is how much. There should be a balance between determining how much to return and also reserving some for future potential investment opportunities. Okay, and in what form? Should it be in the form of cash as dividends, or should the company buy back the shares of stocks called treasury stock? Okay, there's a reason why company buy back the shares of stock. Okay, and we'll discuss that in the future. All right, so the big picture is that any of this investment, financing, or the dividend decision has to maximize the value of the firm. Okay, so again, guys, this is just to recapitulate, just to summarize this. whatever the decision is, the finance function should make sure that whatever the decision here should maximize shareholder value. Okay, it should be maximize the value of the firm. All right. There are very important corollary principles aside from these three activities. We have number one, first is cash flow is king. You notice when we were assessing the investments, we did not use net income after tax. Okay, we used cash precisely because the flow of funds required that we return cash to the creditors or cash to the shareholders. Cash kasi yung binigay nila, they gave out cash, then they expect cash back in return. But how do we compute for the cash flow? There's a way to do that. When we go to capital budgeting, we will learn that in order to estimate cash flow, we first have to estimate the income statement. Okay, then from the income statement, we convert it into cash flow. Okay, and there's a way to do that. But again, guys, it's cash flow is king. And not only that, another important corollary principle is that the time value of money, that money has cost. 1 peso today is not the same as 1 peso after 5 years. Thirdly, the principle of risk and return. The higher the assumed risk, the higher is the required return. I'll give some brief discussion about that in a few minutes. Okay, third is market forces. Okay, what we call the EMH, the efficient market hypothesis. It means that the prices that are reflected in the stock exchange or in any market should contain already all valuable information. Otherwise, if it does not contain all the valuable information, then the market will become inefficient and there will be not many who will trade because they cannot trust that market. And lastly, we have the agency problem. Okay, just to quickly discuss this, in terms of cash flow, guys, bigger is better. The sooner you get the cash inflow, the better. And the less risky the cash flow is, the better. Okay, so bigger, sooner, less risky is better in terms of cash flow. Of course, this is very self-explanatory. The higher the cash flow, okay, the better for the firm. The sooner we get it, okay, so it's better to get the 1 million now or 1 million after 2 years compared to after getting it after 10 years. Okay, the timing, the amount, okay, the magnitude and the timing is very important, and the riskiness of the cash flow is very important also. Okay, so the first principle, okay, foundational principle of finance, cash is king. We know that already. Now, please take note that accounting profit is not equal to cash flow. While it's important to determine net income after tax because it will be used in order to compute for cash flow, but we do not assess projects based on net income after tax. Okay. Also, second, of course, cash flow is what matters. It drives the value of the business. Okay. Liquidity, the availability of funds, of cash in order to propel, to sustain the business. That's very important. Okay, and then we have the incremental cash flow. What do we mean by incremental cash flow? Later on, we're going to discuss this in greater detail. But suffice it to say that, for example, you have this old equipment, old machine, okay? And this old machine will provide the company with certain cash flows. And then if we invest in the new machine, which provides also the company with cash flows, when we say incremental, what's relevant is that we consider the new, and then we have to subtract the old cash flow. And this is called the incremental. Why do we subtract? Okay, we subtract because of this new equipment, we are foregoing the cash flow. We are missing out on the cash flow provided by the old equipment. So that's what we mean by incremental cash flow. That is a relevant cash flow. What's relevant here is getting the net of the cash flow new minus cash flow old. We call that incremental or relevant cash flows. Okay, we'll study that in greater detail as we go on. Next, time value of money. Okay, this has already been discussed. 1 peso today is worth more than 1 peso in the future. Why is that? Because if we invest 1 million today, okay, before the end of 1 year, okay, this will earn interest. Let's say after 1 month, this will earn interest. And the interest is also cash. So in the second month, your 1 million and the interest will earn both interest. So there will be interest on the interest on the interest. That's why at the end of the 1 year, your 1 million is greater than 1 million. Okay, and that explains the reason why we would want to have the 1 million now as compared to having the 1 million after 1 year pa. Because we assume that we can put the money in a vehicle or an instrument that will earn us interest kahit na guys kahit na maliit lang interest. At the end of 1 year, your 1 million will be greater than 1 million already. Okay? Interest will earn also interest also. Okay, next, risk and return principle. What does this tell us? A company or a creditor, for example, is not willing to take on additional risk unless it is compensated with the additional returns. Okay, so if if you know your craft, if you know your business, a lending institution is not willing to take on additional risk if they're not going to be compensated for that. What do you mean by this? Okay, let's have a. I'd like to ask you this question. Globe, okay, has been in the business for very long. Dito is a newcomer in the industry, in the telecommunications industry. Suppose they both need 100 million. Okay, so they would want to borrow, guys, and they would issue bonds. Bonds are long-term borrowings. Okay, so si Globe para will borrow, and they will issue this document called bonds, which is a proof that they're going to borrow this amount, 100 million. Let's suppose that the tenor is 10 years, no? 10 years, tapos ang interest to be paid monthly. Ganun din si dito, also 10 years, and then monthly then. Okay, now one of them issued a 7% bond. The other issued a 7.2% bond. Question, which company issued the 7.2% bond? Okay, was it Globe or Dito? Which company issued the 7.2% bond? So may I have your responses, guys? Which company? Both of them are borrowing. Both of them are borrowing 100 million. 10 or 10 years, ibig sabihin payable in 10 years. Interest to be paid monthly. Okay, one company issued 7% bond. The other company issued the 7.2% bond. Question, which company issued the 7.2% bond? Okay, Dito. Okay. Okay, thank you so much, guys. Okay, in the interest of time, guys, I will not ask any one of you why your answer is 7.2, but you're correct. Why? 7.2% si Dito, guys. Why? Because Dito is relatively a newcomer in the industry. So let's assume wala pang track record dyan, not much track record. Compare that with Globe, which has been in the industry for long. So if they're going to buy 10 years, any financing institution, okay, if they're both issuing 7% bond, then of course we will take on Globe. We will lend to Globe. If both of them will be issuing 7% bond, kasi you're getting the same return by lending to Globe in comparison to Dito. Okay. Now, in what company are we going to assume greater risk? We're going to assume a greater risk as far as Dito is concerned. Okay. Yes, because it's newer, correct? New market player, you're correct. Thank you for those answers. They are all correct. So since this is a newer company, a new player in the market, then we are going to assume a greater amount of risk. Then we should be compensated for the additional risk that we're taking by virtue of greater returns. Okay, so that's the idea behind risk requires a reward. The principle of risk and return. The greater the assumed risk, the greater is the required return. Okay, Fourth, we have efficient markets, no? Okay, itong efficient markets, guys, very important to, yung EMH. Now, I would like to read you, for you to read tatlong klaseng EMH, 3 types, no? We're not going to discuss it here, but these are very important, like semi-strong. I will leave the rest for you to discover. But what's the efficient market hypothesis? It tells us that all the prices of the assets, like stocks and bonds traded in the market, should reflect all available information about the asset. In other words, the market should be efficient. Okay? Why? Because if it does not reflect all available information, then that means there are only some favored parties that have that information, and they can use that information to trade in the market. So nagiging unfair yung market ngayon. The market will become unfair if there are, let's say, what we call, it's called insider trading. There are some who would benefit from that information and will gain against the others, no? And that will not make the market attractive to the others. Many will not invest there because they're saying, oh, we are disadvantaged because there are only some players or some favored participants who are given that information. So that will make the markets inefficient, and that might cause even the collapse of the market. Okay, so when we take a look at the stock market, for example, okay, I'm sorry I wasn't able to. I will have to. Okay, good. I remembered. Okay, so let me just quickly flash this. So where's the PowerPoint? Okay, so it's here. Okay, so take a look at this, guys. Investing.com. So these are the prices of the stocks that comprise the PSA composite. So before I forget, I'll put this here so that you have the reference for this. Okay. All right. Now, what are we saying here? That the 50.6 here, the price of Aboitiz equity, reflect all information pertaining to Aboitiz. So Globe, that's 3,020 per share. If I'm going to invest in Globe, that this price here reflects already all information, all valuable information about Globe Telecoms. Okay. That's why we can say, guys, that, okay, please don't, I need you to cooperate now, PowerPoint. I'm running out of time. Where's my PowerPoint? Okay, this. Okay, so what we're saying here is that usually, if in an efficient market, the price that's reflected there in the stock market or in the bonds market is really equal to the value. Okay, there's actually a difference between price and value. The price is the amount an investor is willing to buy that stock. The value, guys, is the intrinsic value. That's what we call the worth of that stock. So oftentimes, guys, there's a mismatch between this. So for example, let's say we did valuation. When we do valuation, what we do is we use the information about the company and try to come up with a computation for the value of that company. Let's suppose we came up with this value of let's say Globe 3,030. So based on the computation, we determined that the value of Globe is 30.30. Now in the stock market, we notice that it's now selling at 30.20. Okay, then what does that say about the price of Globe? We're saying that Globe is undervalued. Okay, because the value of Globe is really 30.30, but it's selling at 30.20, the price. Okay, in that case, if it's undervalued, then as a financial advisor, I would say buy the stock because it is undervalued. Okay, so we came up with this intrinsic value or the worth of the company using different computations, valuation methods. Okay, so this is what analysts do. They try to find out by computation what the intrinsic value is, what the valuation is, and then they give recommendations. If, for example, the price of Globe was at 30.50, and it turns out that when they computed for the value of Globe, it was 30.30, then they will say that Globe is overvalued. So if you don't have Globe, they will say, do not buy yet, because if it's overvalued. Or if you have Globe stocks, they can say that you can sell. You can sell it because it's selling at 30.50 when in fact its valuation is only 30.30. Okay, so an efficient market, guys, will allow investors to make good decisions. Okay, good decisions will allow the stock price to increase and therefore increase its expected cash flows. Of course, guys, there's a theory that there's no really perfect efficient market. So there may be inefficiencies in the market that may distort the prices. Exactly what I was saying a while ago. Itong example natin. Okay? And lastly, guys, conflicts on agency. That's why in, okay, it's almost time, guys, so I have to hurry up a bit. That's why in some companies, they have this ESOP. What's ESOP? This is the employee stock option plan. Okay, why? Because there could be conflicts between the professional managers and the owners. Okay, professional managers might do things that are inimical to the interests of the shareholders. Okay, so that happened really, guys, and there were so many problems about this, so that there are now principles on good governance. Okay, one example is that before, the board of directors used to be anybody. Now it's required that the board of directors, there should be an independent board of directors. Okay, when you say independent, wala silang interest dun sa firm, so they can give comments that are really objective. Okay, so conflicts of interest cause agency problems. All right. So actually, guys, corporate finance is really common sense. Okay, so let me end in these few slides. Common sense, because we have to take investments that are great, the returns of which should be greater than the cost. Diba? This is not rocket science. Only accept investments where the returns are greater than the cost of acquiring funds. Diba? Investment decision making yon. Okay, so another common sense is that finding a funding mix that only costs the company 12% is better than finding a mix that costs the company 13%. In other words, a WACC of 12% is better than a WACC of 13%. No? What does it mean to have a WACC of 12%? It means that the cost of acquiring funds from debt, from stocks, is equal to 12% as compared to 13%. And the cheaper, guys, the funding, the WACC is, the better for the company. Okay, and then what does this say? It's also common sense. If the company can find an investments where the returns is greater than the WACC, then maybe it would be best to return the cash to the owners of the business. So not only is corporate finance commonsensical, it's also focused. Okay, when you say focus, it means that the main objective should be to maximize shareholder value. We're not saying that it's not important to consider the interests of the customers, the suppliers, and the other stakeholders. They are important, but primarily the focus should be a singular objective, maximizing shareholder value. And what's the implication of this? Choosing the right investment, choosing the right mix of financing, choosing the right decision, whether to return cash to the shareholders or not. Right lahat, right investments, which means that sa mga investments, possible investments, the one that gives the highest return, IRR and NPV, should be the one chosen. By the way, guys, I forgot to tell you, when there's a conflict between IRR and NPV, it's always the NPV that prevails. Okay, we'll discuss this in greater detail in the near future. But pag nagko-conflict yung IRR says don't pursue the project. but NPV says pursue the project, then always follow the NPV because it's a more theoretically sound way, the more correct way to do decision making for finance. Okay, we'll explain that more in detail in the future. Right financing mix and right decision to return cash or not to the shareholders. Okay, so it's focused, and lastly, it's universal. Ano ibig sabihin ng universal? Anong klase man business, no? Small, large, public, private, mature, or emerging market, the objectives will still be the same, to maximize value. Okay, now there might be differences. Okay, for example, a publicly traded firm may have more access to capital markets compared to a private business. But still, ang objective nila, dapat yung financing mix nila should be the one that minimizes cost of capital or the one that maximizes shareholder value. Ganun din guys, a firm may be in an emerging market, malaking uncertainty, okay, or nasa developed market na siya, but both firms should only invest in, put their money in investments that maximizes or that's greater than the weighted average cost of capital. Okay, I'm sorry guys, I extended time. Last slide guys, I want you to read on this. Now, it's very difficult now in the business sense because of the VUCA world. What's the VUCA world guys? Volatile market, uncertainty in even in consumer behavior, napaka-uncertain, napaka-complex na ngayon guys ng business environment, and also very ambiguous. Okay, so this is the environment in which businesses compete in. So the role of finance is very, very important because businesses now live in a VUCA world. Okay, so with that guys, thank you so much. I now stop recording. Thank you, and I'm sorry if I was